Hello, Paragon traders. This is Matthew Stevenson, and today we're going to talk about a fundamental principle of trading Forex, spot FX trading. Imagine buying a euro with dollars this second, not next month, not on a futures exchange, right now. That instant exchange is the heart of the global foreign exchange market, and the transaction type is called spot FX. In the next 20 minutes, I'll explain step by step what spot FX trading is, how the market works, and what you need to know before you trade. No fluff. Just practical, trader-focused basics. Spot FX, short for spot foreign exchange, is the market where one currency is exchanged for another for immediate settlement. Immediate typically means 2 business days for most currency pairs, or 1 business day for US dollar to Canadian dollar. But traders treat it as right now. Spot FX is the most direct way to trade currency moves, and it's where retail traders, hedge funds, banks, and corporations all interact. Mechanically, spot FX is an over-the-counter market. That means trades are executed bilaterally through brokers, banks, or electronic trading platforms, not on a single centralized exchange. Price discovery happens continuously. When a buyer and a seller agree on a price, the trade executes and the currencies are exchanged. For retail traders, this is usually handled by your broker who nets positions, routes orders to liquidity providers, and settles the opposite side with the interbank market. The market's participants range from central banks and multinational corporations performing real economic currency conversions to proprietary desks and retail traders speculating on exchange rate moves. Key layers include interbank market, electronic communication networks, and retail liquidity providers. The mix of participants is why FX is extremely liquid, especially in major currency pairs, and why spreads can be very tight. $9.6 trillion every day. Currencies are traded in pairs. The first currency is the base. The second is the quote. If euro to US dollar equals 1.1200, 1 euro costs 1.12 US dollars. Pairs are grouped as majors, minors, or crosses, and exotics. The convention matters for pricing, liquidity, and trading cost. A pip is the smallest standard price increment for most FX pairs, usually the 4th decimal place. For JPY pairs, it's the 2nd decimal. Some platforms display pipettes as an extra digit. Lot size defines how much currency you trade. Standard lot is 100,000 units of base currency. Mini is 10,000. Micro is 1,000. So a 1 pip move on a standard lot in euro to US dollar equals roughly $10. Know these units. They're central to calculating profits and losses. Spot FX is commonly traded on margin. You deposit a fraction of the notional position, and the broker lends the rest. That's leverage. If your account margin requirement is 1%, you have 100 to 1 leverage. Leverage amplifies gains and losses. A $1,000 account using 100 to 1 leverage can control $100,000 notional, but a small adverse move can wipe the account quickly. Always calculate required margin and know the broker's margin call and liquidation rules. Common order types: market orders, limit orders, stop orders, take profit, and stop loss orders. Execution can be instant or subject to slippage in fast markets. Many retail platforms also offer OCO and trailing stops. Choosing the right order type is as important as the trade idea itself. FX quotes show bid and ask. The bid is what buyers will pay. The ask is what sellers will accept. The difference is the spread. Spreads vary with liquidity. Majors during London and New York overlap have razor-thin spreads. Exotics or off-session times have wide spreads. Brokers may offer fixed or variable spreads. Variable typically narrower in normal conditions, but widen during stress. Liquidity providers and ECNs compete to offer the best bid and ask. That competition is what keeps costs low in liquid pairs. Traders use 2 broad approaches: fundamentals and technicals. Fundamental analysis studies macro drivers such as interest rate differentials, economic data, central bank policy, geopolitical events, and trade flows. Technical analysis uses price action, support and resistance, trend lines, and indicators to time entries and exits. Most experienced traders blend both, using fundamentals to set the directional bias and technicals for execution and risk control. Let's walk through a simple hypothetical trade. You see a stronger than expected U.S. jobs report and expect USD strength euro to US dollar is at 1.120. You decide to short euro to US dollar at market. Step 1. Position size. You risk 1% of a $10,000 account, which is $100. Step 2. Stop loss. Technical resistance suggests a stop 60 pips above entry. Step 3. Calculate lot size so that 60 pips risk equals $100. For euro to US dollar, Each micro lot is about 10 cents per pip, mini lot about $1 per pip, standard about $10 per pip. You choose a mini lot. 60 pips times $1 equals $60 risk. So you could size up to 1.6 mini lots to match $100 risk. Step 4. Place trade. Set stop loss and take profit. Monitor. If USD continues stronger, you exit for profit. If not, stop loss limits your loss to predefined risk. Risk management is the single most important discipline in FX. Rules to consider. Never risk more than a small percentage of account equity per trade. Diversify ideas. Use stop-loss orders and size positions by dollar risk rather than percentage of leverage. Also manage aggregate exposure. Correlated trades can amplify risk. Keep a trading journal and measure expectancy. If your expectancy is positive, your strategy is viable. Common pitfalls. Over-leveraging. Trading without a plan. Revenge trading after losses. Ignoring slippage and transaction costs, and failing to adapt to changing markets. Psychology matters. Control fear and greed. Stick to rules, and treat trading as probability management rather than guaranteed income. Small, consistent edge plus disciplined risk management wins over time. If you want to start trading spot FX, 1. Learn the basics. 2. Choose a regulated broker with transparent pricing and good execution. 3. Open a demo account and practice order types, risk sizing, and a trading plan. 4. Backtest strategies and keep a journal. 5. Start small on a funded live account. Use realistic leverage and scale only after sustained profitability. Always check fees, swap, and rollover rates and the broker's margin rules. Spot FX is the real-time market for exchanging currencies. It offers deep liquidity, 24/5 hours of trading, and powerful leverage, but with real risks. If you walk away with one practical takeaway, size your trades by dollar risk and always define loss limits before you enter. If you found this useful, like and subscribe for the next video where we'll open a live demo trade and analyze execution step by step. Questions or trade ideas? Drop them in the comments. I'll pick the best for the demo.